Hello, I'm Jim McLendon, President of McLendon Mortgage Company, and I'd like to welcome you to the presentation, Grow Your Business with the First-Time Homebuyer Tax Credit. If you remember just one thing from today's presentation, it's that small decisions regarding rate and down payment can have huge implications on your borrower's overall financial well-being. With that in mind, I'm going to assume that by now we are all familiar with the guidelines of the 2009 First-Time Homebuyer Tax Credit. Therefore, I'm not going to spend a lot of time covering the subject, but instead focus on just a couple of relevant changes and how these need to be examined so your buyer can take full advantage of these changes. FHA now allows the borrower to use their tax credit towards their down payment, but remember, the borrower is still required to put 3.5% down from their own funds or from those of a family member. Once this requirement is met, the borrower is allowed to use the remaining tax credit towards his or her down payment in order to reduce the loan balance. The borrower may also use the tax credit towards closing costs and or points to buy down the rate. The money from the tax credit is available in the form of a loan from an FHA-approved lender or FHA-approved nonprofit. For more information on these guidelines, I'll post them at our website at mclendonmortgage.com. Now, we're going to look at a case study that will help illustrate the importance of understanding these changes and how you can leverage this knowledge to grow your business. Our case study involves two friends. They have identical jobs and identical salaries, each earning $58,000 a year. Both of them have excellent credit with minimal debt. They have generous parents who are going to provide each of them with a gift of $7,000 for their down payment, and they're first-time homebuyers. Our two friends are each working with a realtor, and as luck would have it, they have both found their dream home. The problem is, it's the same home. The home is priced at $200,000. They are each seeking FHA 30-year fixed-rate financing at 6.25% with 0 points. Unfortunately, the 3.5% down payment, or $7,000, will be covered from the gift from their parents. Based on these facts, the total monthly payment, including taxes and insurance and MIP, will be $1,547.59. The problem is that in order to qualify for financing on this property, they're going to need a minimum of $64,032 in annual income, and as stated before, they each only make $58,000 a year. So let's follow these two and find out who, if either, will be able to buy their dream home. Meet Wilma. Wilma has been advised by her realtor to call a couple of lenders and see what she can do. She chooses a lender and is told that she qualifies for the first-time homebuyer tax credit of $8,000 and that FHA is going to allow her to use the tax credit towards additional down payment. The loan officer advises her that if she uses the $7,000 gift from her parents as well as the $8,000 tax credit, a total of $15,000, her maximum purchase price will be $185,000. Wilma follows his advice and offers $185,000 on the house, with loan terms as follows: $15,000 down, a total loan amount of $172,975, including her $1.75 upfront MIP, and a monthly payment including taxes and insurance of $1,392 a month. Friend number two is Betty. Betty has been advised by her realtor that the market is improving and there is a great deal of interest in this property. The property is listed at appraised value and a lowball offer will probably not go. Betty's realtor advises her to contact Jim McLendon at McLendon Mortgage Company. At their meeting, Betty and Jim discuss her financial goals as well as how long she plans on keeping the property. She states she does not wish to use up all her money from the tax credit in the transaction, and she wishes to pay off her mortgage quicker than the 30 years. Based on their conversation, McLendon Mortgage Company prepares a total cost analysis for the loan program that best meets Betty's needs. McLendon Mortgage Company proposes a 30-year fixed-rate loan with Betty paying 2 points or $3,927.54 to buy her interest rate down to 5%. Betty can see that based on the recommendation of McLendon Mortgage Company, she will also be receiving a $277 per month in tax savings. She can use this information to request that her employer adjust her tax withholding so that she can increase her net take-home pay by the $277. And of course, before she does this, she runs this by her accountant to make sure it's okay, and of course it is. McLendon Mortgage Company next uses the total cost analysis to show Betty the impact that paying an extra $277 a month will have on her total mortgage costs. The result is she will be able to pay the loan off in just over 19 years and save over $74,000 in interest payments. Now think about this. Betty will be able to pay off the loan in 10 years early without increasing her monthly debt, and it's all done utilizing her tax savings. Okay, so let's compare the final numbers. Wilma, on the advice of her loan officer, is going to need to submit an offer no higher than $185,000 with $15,000 down. She'll get a 6.25% interest rate fixed with a payment of $13.92 a month, but she won't have any money left from her tax credit. Betty, on the other hand, will be able to submit a competitive full-price offer. She'll only have to use $7,000, which is the gift from her parents, for the down payment. She'll receive a 5% interest rate paying 2 points, and she'll have $4,072 remaining from her tax credit as a cushion for future expenses. In addition, look at the payments. Even though Betty's borrowing a lot more than Wilma, Betty's payment is actually a few pennies less. The winners in this case, the first one is Betty. Now remember, she was originally looking just for options to qualify for a mortgage. But the advice of McLendon Mortgage Company is going to result in her saving over $4,000 of her tax credit that she can put in the bank. She's going to pay off her loan in under 20 years and save over $74,000 in interest. The realtor also wins. Your recommendation resulted in Betty not only getting her dream home, but saving a boatload of money in the process. You increased referrals because Betty was so happy with your services that she recommended you to all her friends and coworkers. The seller of the home is happy and impressed, as well as the neighbors, because you were able to secure top dollar for their home, as well as help maintain the value of the neighborhood. As we wrap up, I'd like you to remember that now more than ever it is important to distinguish yourself from the competition. I can assist you with this. At McLendon Mortgage Company, we are committed to helping our business partners grow their business, and we do this by helping you increase client satisfaction, by educating the client about the mortgage process, and providing them with financing that meets their individual goals. In addition, we provide you with market-relevant information that allows you to position yourself with your clients as a trusted advisor. So to receive a complimentary total cost analysis for one of your clients, shoot me an email at jim@mclendonmortgage.com or visit our website at mclendonmortgage.com. Thank you.